What I always like to start out with is, you know, uh, kind of a quick story. So let's meet let's meet Thomas. Thomas was a 35-year-old marketing executive. He wanted he was sort of stuck in a rut, and he knew a business acquisition may be a path he was interested in. Uh, he's a top performer at a Fortune 500 company, and but he wanted to get into small business acquisitions. Um, Thomas was stuck in strategy meetings, and he was scrolling business listings. He would often say to himself, "I know I could run a business successfully, but like, where do I even start?" Um, and he was trying to balance his ambitions of buying a small business with the realities of the financial security of his current job. So, like many folks, Thomas tried the DIY approach. He did some self-research on nights and weekends. He read the Buy Then Build book by Walker Dybel. He read the Harvard Business Review book about how to buy a business. But Thomas was struggling with the analysis. He was struggling by and frustrated by the setbacks that the process was not moving fast enough. But then one day, Thomas found his ideal business. He was scrolling and had that eureka moment. But now Thomas asked himself the question, now what? Um, Now what should he do? Um, and he sort of had that eureka moment. Now what should he do? Should he call the listing? So Thomas had the courage, and he made that call. Thomas calls the owner, and the owner picks up, and he says, you know, hello, I'm interested in buying your business. And then suddenly Thomas freezes. He freezes, and he's not sure what else to say. This the story about what's next after you find that business sets the stage for what a lot of self-funded searchers realize once they're in this journey, that every business and the people involved in the business are all unique. So knowing what to say, when to say it in a clear and efficient manner is almost as important as finding the business listing itself. So the 30-minute framework is one of those tools in your toolbox you can use when you're talking to these small business owners to quickly assess, is this a good business? Financially, does it check a lot of your buy boxes? And then most importantly, what to do next. Um, that sort of inflection point is where a lot of folks get tripped up. So hopefully, you can use this as your toolbox as you're meeting these sellers. So let's set the stage for the 30-minute framework. So why does the balance sheet matter more than you think? So a lot of buyers will focus on income, but the balance sheet is where deals get made or broken. And I'm going to talk about that a little bit later. While I'm diving through the topic, if you have questions throughout, feel free to put them in the chat, and I will try to get to those as soon as I can. I always like to get a sense for who's kind of in the crowd. So where are you today in your business search process? Are you under LOI, actively searching, or are you just starting out your search? So if you want to respond to that polling question, it's helpful to see who's in the audience to get a lay of the land for some of the folks. Depending where you are in the search process, we can sort of tailor the narrative accordingly. So where are you in your business search process? I'm going to give a couple more folks time to answer. Um, it seems like a good amount of the crowd is actively searching, which is wonderful. One individual marked under LOI. So pay close attention to this because the balance sheet discussion is going to be super important. All right, I'm going to go ahead and end the poll. So it looks like, about half of the folks who chose the polling question are about actively searching. Um, all of these things are great stages. If you're new to the search, um, this conversation, I would encourage you to register for all of the upcoming ones where we kind of do a deep dive into deal sourcing, other topics around buying a business in the, ETA, self-funded and lower middle market. So feel free to be on the lookout for that a little bit later. Um, so what does, so why does the balance sheet matter more than what most people think? The real reason is it's due to a lack of understanding. Most folks, whether you come from a financial background or not, can digest the income statement. They understand sales, revenues, they understand expenses of the business, cost of goods sold, um, rent expenses, and then they understand what net income is. The income after revenue minus the business costs. Uh, what a lot of folks don't understand is the balance sheet. And the reason why is because the balance sheet is a very much an accounting exercise, which relates to how certain activities of the business are recorded um, from, the balance sheet and income statement side. So, for example, the one example is the income statement trap. So this is something that the revenue looks great, but in reality, there is $800,000 of aged accounts receivable that are past due that may not be collectible. Uh, Things like margins, gross margins look very strong for the business, but inventory on the balance sheet is stale and it might be unsellable. Uh, Things like EBITDA is strong, for example, north of 1 million, but there still sits a large amount of uncollectible receivables already recorded as revenue. These traps that you will uncover as you're reviewing income statements is why the balance sheet is so important, and understanding the quality of the balance sheet is the true value of what you're buying. I always say the balance sheet is where buyers can get hurt the most, and it's really due to a lack of understanding. What the balance sheet reveals, if done correctly, is the true quality of the receivables you're buying, whether inventory has a real value, or can it be sellable and create new dollars for you as the owner? Um, and then understanding how much working capital you need on day one after closing. Uh, Again, understanding the differences and some of the traps in the income statement and how it relates to balance sheet is going to be something in a narrative I talk about throughout this conversation. If you have any questions about specifics around the balance sheet, again, feel free to put your hand up and we can talk about it. So, what is the balance sheet evaluation? So, the balance sheet evaluation is understanding the comprehensive picture of the financial position of the company and the stability of the company. It's done by examining a few things like the cash management, the accounts receivable, and the accounts payable. If you're looking to buy a small business with an SBA loan, the primary components of your balance sheet are going to be an AR, AP, inventory, and the cash. Double clicking into accounts receivable, the evaluation at the accounts receivable level is going to be around things like the aging schedules and the collectability of accounts receivable reported on the balance sheet. So when you're given a balance sheet from QuickBooks or a company's financial reporting system, it's likely going to have come in an Excel copy, and it's going to have things like accounts receivable and accounts payable. Understanding how old these receivables and payables are is really the first question you need to answer. And that will help you assess if the company is correctly recording and giving credit for some of these items. So here's laying the lay of the land for the 30-minute balance sheet framework. So if you only had 30 minutes to review a balance sheet, what would it look like? What I would start is I would scan the structure, get oriented, understand what's in current assets, current liabilities, what's in long-term assets, long-term liabilities. And then I would spend some time drilling into the assets. Understand what is in accounts receivable. Who are the customers in accounts receivable? Are there significant large balances in accounts receivable? Is it spread evenly throughout? Understand what's in prepaid. Are there prepaid expenses in the balance sheet? What do they relate to? Are they prepaid insurances? Are they prepaid software? Is it a material balance or is it a small balance? Understand inventory if it's applicable. So if you have a business with significant inventory on the balance sheet, that is a risk. And it's a risk because you need to understand what is the quality of inventory. Is the inventory stale? Or is the inventory sellable going forward, as I step into the new ownership? All of these questions can be dollar for dollar savings or dollar for dollar items you leave at the table for these small business acquisitions. Then I would quickly scan the liabilities. Again, just a 30-minute framework. So moving down the balance sheet, after the current long-term assets, you're going to have current liabilities. This is going to be things like accounts payable, accrued expenses. And then it's going to have things like deferred revenue, maybe some loans payable, notes payable in the long-term liabilities. If you are buying a business for a stock sale, all of the liabilities and assets of the company are now going to be transferred to you. If you're doing an asset sale, it's not always going to be the case, but still, you need to get an assessment for what are the obligations of the company? What are these liabilities that the company is taking on? And then you're going to calculate working capital. If you don't know how to calculate working capital, I've held several individual webinars about this. Working capital definitionally is the current assets minus the current liabilities. So the number that you calculate for working capital is from this balance sheet. The question, what is the NWC peg? That relates to what is the net working capital peg? The net working capital peg is the target dollar amount of working capital you think is appropriate to be delivered by the seller at the time of closing. For purposes of this, I'm not going to get into the weeds of working capital. I would point you to one of our other webinars, which you can find on my YouTube channel, where we specifically dive into working capital. But effectively, in the last 5 minutes of this 30-minute exercise, I would roughly calculate reported working capital And then I would do this red flag review where I compare the periods of working capital for the last 12 months. So I would compare what working capital looked like in 26. I would go back a year and look at how did working capital move in 2025 and then 2024. And the reason why I'm looking at this month to month trend is I want to understand, are there certain spikes where working capital increases? When working capital goes up, it's likely due to accounts receivable going up. And accounts receivable goes up when there's sudden spikes in revenue. So if the company is seasonal, so for those looking at seasonal businesses, pay close attention. Um, if the company is a seasonal business, it's very likely working capital will fluctuate during the periods that are busy and then drop during the slower times. Um, these sudden spikes and concentrations will set the stage and give you a roadmap for what is financial diligence going to look like when you do go under contract or under LOI for this business. Because those are going to be things you're going to need to dig deeper. And again, for purposes of this exercise, this 30-minute framework is to assess and better structure a roadmap for what due diligence is going to look like going forward. This exercise and more has been compiled in the Business Buyer's Toolkit. This is a toolkit I've comprised for the last decade. It has some of my best templates, like the financial due diligence data checklist, um, what a 90-day LOI period looks like. So feel free to scan this QR code and you can receive a copy to your email today. So let's drill into the assets. So this is the first piece of the 30-minute framework. So when we drill into assets, it's important that we focus on a few things. So for most small business acquisitions, your primary assets you will need to drill into is accounts receivable, inventory, and prepaid and other items, other assets. Uh, Double clicking on inventory, because we talked about accounts receivable. Inventory, you want to ask yourself a few questions. What is the age of the inventory on hand? So when you look at it, what that means in practice is when you look at a balance sheet report from QuickBooks, if the company has inventory, there's going to be a line in the balance sheet that says inventory, and it's going to show you a number. Underneath that number is likely a schedule of the inventory on hand. When I look at businesses for the first time, I'm going to ask myself, and I would probably ask the seller, what if I were to look underneath the hood of this inventory item, what would it be comprised of? Is it comprised of many items, many small items, or is it comprised of a few large items? If the answer is a few large items, that's going to be much easier to digest. If it's thousands or hundreds of thousands of small dollar items, that's going to be an exercise I would probably leverage a QAV provider to do an inventory analysis on your behalf. The reason why is because it's an extensive procedure where we are going to analytically test and review the inventory detail to see if there are items that have not moved in the last 12 months. The reason why we do this is we're asking ourselves, are there any items in inventory that may be obsolete, damaged, or unsellable? If you think about some of these legacy small businesses, some of these businesses that have been around for 30 plus years may have inventory that have been on the books for 10 plus years. If you don't believe me, I see this in practice all the time. And when you ask sellers about some of this old inventory, they will say something around, it's still on the books. One day I may sell it. Um, the reality of it is, if the inventory does not relate to a service or a widget they're actively creating today and selling, it's very unlikely that you, as a new buyer, are going to actually move and sell that inventory. How it relates to your deal is, if there's items in inventory that is deemed to be obsolete or unsellable, you should not be paying for those items, and including those items in working capital at the time of closing. If you have questions about that specifically, that's where a lot of people will get tripped up around. So happy to answer questions. But that's the point of the inventory analysis. If you are buying in an asset sale, you might be spending dollar for dollar on this inventory. Sometimes they tack it onto your acquisition. So if you're spending a dollar for dollar the value of inventory, it's even more important to assess that all the items you're paying for, you can actually sell. Otherwise, you could be losing dollar for dollar buying any goods that are deemed, unsellable. For accounts receivable and AP, for accounts receivable, you want to request the AR aging details for the last 30, 60, and 90 days. So if you were to ask for a report as of the end of April, since we're sitting in May, I would schedule out and look at the items that are aged more than 90 days. So if there's receivables that were issued in the beginning of the year, let's say even in late last year in December, those items are going to be shown in this greater than 90-day bucket. It's a report you can run in QuickBooks. If you don't know how to run this report, I would encourage you to leverage a financial due diligence provider to conduct this analysis on your behalf. And the reason why we're looking at significantly aged accounts receivable is we're assessing the collectability of this AR. If the company is recording on an accrual basis, when they issue accounts receivable in line with generally accepted accounting principles, referred to as GAAP, when they issue an AR, accounts receivable for a customer, they are recording revenue. So it goes back to the point of the income statement trap. If you're looking at the income statement and you see revenues going up, you're getting really excited about this business. If some of those revenues are from customers that are never going to pay and deemed uncollectible, those revenues should actually be removed. It's not reasonable for you to pay a market multiple for revenues that are deemed uncollectible. Let me give you another example I see in practice. For insurance-based work or medical-based billing, occasionally small businesses will bill items that are too high and will never be collected. In the case of insurance-based work, there are certain home service companies that will bill in excess of the insurance policy, which will never be collected and paid for by the insurance company because it's outside the coverage. I see this often in practice where there's a significant amount of receivables that are sitting on the books due to partial payments by the insurance companies because the billings were in excess of the policy. So if you're working on a roofing deal that does a lot of insurance work, pay close attention to this. This is something I see a lot in practice. You don't want to be paying and giving them credit for incomes due to simply overbillings. That's something that a lot of buyers will get caught up with, and they will not put two and two together when they see the incomes going up. That's a good thing. But you need to ask yourself, are those revenues actually being collected in a reasonable basis, or is there a risk that the company may be aggressively billing just to show inflated numbers? Step three and four is the liabilities. So when we're mapping liabilities, it's going to have things like what is the debt of the company? Does it have bank lines, term loans, equipment notes? Are there any deferred revenues? Are there prepayments from customers? Prepayments of work to be started soon? If for larger projects, I see in practice, customers will prepay 50% of the project ahead of time. If you're a business buyer, you need to understand when is that work going to be completed? Because the risk is if you're a new owner and you step in, if you have paid for these prepayments ahead of time, you may need to be on the hook for some of the labor costs to actually complete this work. So you don't want to be giving the old owners extra credit when you're going to have to cover the labor costs for this work to be completed. That's where I see a lot of deferred revenue items and questions and deals occur. For construction type projects, the WIP analysis is something you're going to need to spend a lot of time with. If you don't know what a WIP analysis is, again, if you're under LOI, you want to engage a financial due diligence provider with construction experience who have done WIP analysis before. Um, a lot of times, this analysis can be a dollar for dollar savings or loss if done incorrectly. And then it's going to have things like accrued liabilities, vacation, bonuses, payroll liabilities, um, and then other things, such as related party payables, and then some contingent liabilities. Uh, when you're thinking about and you're scanning this 30-minute framework, those are things to pay attention to. We talked about the working capital calculation, referred to as the working capital peg. It's really the assets minus the liabilities. Um, a tip I like to use is the working capital peg should be based on a certain trailing average. You should not be selecting a peg based on a single month or a few months. My recommendation is you want to select a peg that's a 3, 6, or 12-month average. Occasionally, if the business is very steady, you could do 24 or maybe even a 36-month average. I don't see that a ton in practice. A lot of the working capital pegs I will recommend will be really the 3, 6, or 12-month average of the normalized working capital. So, what's the 12-point checklist for some of the balance sheet red flags we see? So, if you see three or more of these, I would recommend you seek proper representation from a QOV provider to do a balance sheet analysis. If you're seeing accounts receivable increasing year over year, and also the collection is going up, so there's more AR that's 90 days or 120 days old. If a single customer represents 30% of receivables, that's a red flag. Um, if your inventory balance is outpacing your revenue, that's also something you want to look into. Um, if deferred revenue is not matching how the company is describing the operations of the business. So, for example, if the company is taking 50% prepayments on projects, if you head over to the balance sheet and you don't see them recording deferred revenue, that's a yellow flag. To me, that would indicate the company is not properly accounting for deferred revenue when it comes in the door. That would lean, my inkling there would be that the company is reporting on a cash basis, um, and they're not following these generally accepted accounting principles. So you want to leverage a buy side accountant like an OAG to do this on your behalf. Um, and then there's significant balance sheet items that haven't changed in the last 6 months. So I refer to these as stale general ledger accounts or stale balance sheet accounts. So if you see an account that has the same balance for the last 3 years, you want to ask the question, what's the nature of this account? Like, what does it entail? What are the details of it? Tell me more about it. Um, it's something you want to assess before you reach the closing table to avoid surprises. Here is a live deal, and there's a lot that goes into this page. But effectively, if we were to think about, a few shop locations, and each shop had a balance sheet at a given point in time. Uh, so if you're buying a multi-entity company, um, a business with multiple clinics, a business with multiple shops, very likely, if they're doing a decent job at the financial reporting, they are going to be tracking cash, incomes, etc., at the store, clinic, or shop level. So that's really what this breaks down. It's like if you were to look at a balance sheet and you see multiple shops, using the same fundamentals and applying it across multiple entities is best practice. So when it comes to the balance sheet review, you want to assess what is the individual performance on a profitability standpoint and the balance sheet standpoint by each location. So when there is, you know, shop one, two, and three are examples of liquidity, rapid scale success, and balance. When I think about balance for an individual entity, it's steady growth or steady consistency year over year. Um, Rapid scaling would be likely a surge in the current assets of the company, which looks good on paper, but in reality, it can also cause many risks about these deals. So if you're seeing a company with sort of a whipsaw of accounts receivable that goes up, I would expect sales to follow suit. Um, you want to spend more time assessing how the company is billing those accounts receivables and then assess the collectability. The risk for a buyer is you are giving them extra credit for receivables that may not be collected. So, what are some key takeaways in the 30-minute session of the balance sheet review? As we come a little close to the 40-minute mark, we did kind of knock out the big pieces. So, the balance sheet reveals what the income statement hides or what the income statement may be showing, and it sets the stage for uh, a proper roadmap for your deal. So if you're seeing accounts receivable increase, sales go up, you want to assess what is the collectability of that? Um, what are the cash management of the company? What's the quality of the receivables? What is the quality of AP? And use this 30-minute framework to quickly assess the balance sheet integrity of the company. The reason you assess it is to calculate working capital. If you're buying a small business, within the LOI and purchase agreement, you may have stipulations around things like the seller will deliver an appropriate level of working capital at the time of closing. The level of working capital is your right to these accounts receivable that the old owner hopefully paid for, and you just need to collect. Um, so these are dollar for dollar items, which you, if structured correctly, can be granted the right to fuel business growth and sustain operations. I always like to describe working capital as buying a car, and working capital is the gas that goes into the car. If you were to drive off the lot with a new car today, you'd be pretty upset if the car had no gas in it and you had to head over to the gas station and spend, you know, in today's rate, $4 or $5 a gallon just to get home. Working capital is the gas that fuels the business when you step in on day one. If you don't calculate working capital correctly, you may need to fuel the business with your own cash or another set of cash that's available, um, which causes a lot of challenges for new owners if you don't have these cash resources on day one. Um, so the balance sheet integrity goes hand in hand with working capital and why it's so important. Uh, Key takeaway number 7 is if there's 3 or more red flags in the 12-point takeaway right here, you want to leverage proper representation. Uh, Transaction CPAs, like the folks over at O'Connell Advisor Group, we do this for a living. Uh, our balance sheet analysis is very thorough, and it really sets the stage for proper closing, and it protects yourself as a buyer. Too often, I see a lot of folks um, without proper representation, and it really hurts them on day one for businesses that they close, and it just increases the inherent risk of buying this small business. There's a lot of things that go into it, such as there could be issues with how the company's recording the balance sheet, things like deferred revenue, things like accounts receivable, um, and other current assets and liabilities around inventory calculations. So just keep an eye on that and work with proper representation for what very likely is the largest investment of your life. The last thing is, you know, key takeaway number 8 is the related party loans and the off books obligations can be something that really hurts you as a buyer. If there are undisclosed liabilities or obligations you're inheriting from day one, um, that could be very risky and costly if you don't know these ahead of time. There are things to mitigate this, like reps and warranty insurance, etc. But having the information through this proper balance sheet analysis can really save you a lot of headaches when you do buy this new business.